All right, hey guys, what's going on? Gonna get into it. Have a new pad down here in Miami, so I can pay less taxes and run the little hedge fund I'm running, which needs to be based in Florida for investor purposes. I haven't done a video in a little while. I've been having a tough time in these markets, to say the least. Bitcoin treasuries have been getting cranked. The other miners that I was liking, Mara, CleanSpark, really only those two. Also been getting cranked. I had pretty good entries on those, so didn't take too much of a beating. But nevertheless, things are tough out there. First, I'll open up with our performance. So since inception, Stravera, my hedge fund, is down 6.3% since yesterday's close. It's going to be a little worse than that after today. Bitcoin's down about 5.7%, and the S&P is up 6.3%. So who would have thought a Bitcoin hedge fund was underperforming the S&P? But nevertheless, we're holding our own against Bitcoin. I want to first hop into Treasury yields. You can see expectations of cuts through the end of 2026, and you can see the expectation of where rates will be, short-term rates below 3.5%. I've heard Paul Tudor Jones and others online talk about rates as in the high twos if cuts will continue, depending on what the Fed decides to do. Now, mortgage rates are on the decline as well. You can see the 30-year mortgage rate is just over 6%, down from its peak in 23. Not much to see there. I don't expect these to fall as much as some people may hope, but the Fed does need to keep cutting. Some of the important upcoming macroeconomic factors: we have a 97% probability of a 25 bips rate cut in October. December, another 91 to 94% probability of 25 basis point rate cut. So you can see median Fed funds projections of 3.5% year end. This has large implications for Bitcoin-backed credit, as we all know, even though it's trading like garbage these days as well. So long-term target around 2 to 3% for the neutral Fed funds rate. Fed dot plot, people have gone over that before. Unemployment expected to be 4.5% in Q4 2025, declining to 4.3% by 2027. So the expectations for employment are really, no one knows. Core PCI 3.1%, returning a 2% target by 2028. I expect this to not be the case if they want to go through cutting, if they're going to continue cutting through 26 and into the beginning of 27. I see no way in which inflation's kept under control. What that means is I don't think they'll cut as low as people are anticipating, and so that would be difficult for growth. We'll see, or maybe just the inflation is reported as not the actual inflation. We just keep playing this little game where the debasement trade remains on. Treasury yields, same photo. Now look at the ISM and the manufacturing PMIs. I think these are the ISM manufacturing services PMIs. I think these are super important and relevant to what we're doing. So there's been some work done by the Insights.NAV people, Marty Kendall, and this has just been an incredible overview and analysis of how Bitcoin's been extremely correlated to the hash rate, which is a proxy for overall user growth, then the PMIs overlaid being essentially the cyclical bubbles. I'm a big believer in the power law. I think if you're a Bitcoin believer, that's the reason why you believe in it, because it's a monetary network, and as it's being adopted, which you can see via the power law, then the price should go up at a square root of the hash power and at the square of the new user addresses. Or I forget exactly how it works. I have it right here. So price should go up with the price should be in the power sixth, so it should be square root of the hash rate. Hash rate, it's about time to the power 12. Working through the article, you can see where we sit along the power law trend, and we are right smack dab on it. Very hard to trade if you expect bubbles to occur, which I think they will. So that would be reflected in a higher PMI, services and manufacturing going into 26. With rate cuts, we could see that bubble we've been anticipating for so long. Now, I don't know if that will occur necessarily, but I think the risk of not being exposed to Bitcoin is greater than being exposed to Bitcoin. I think there is considerable downside risk or potential over the next year, or chop potential. I don't know how to trade it, but let's hang in there and see where we go. Now, Bitcoin priced in gold, those charts are great, but they're difficult to really parse through. I think an inflation-adjusted power law index is what I like to use, maybe, power law plus 7%, because gold's been outperforming real debasement over the past few years. Now, Bitcoin versus M2, this is the final chart that they've created, Bitcoin versus actual forecast. So if you inject the PMIs overlaid so their first study is using M2 hash rate, S&P, and gold, gold being a very limited variable, you get this sort of trajectory of BTC, which we're following quite accurately. And then if you use the PMIs in this algorithm, you get this sort of price following based on these external components. So it's no wonder we haven't gone through an extreme bubble, simply because the PMIs just aren't where they've been during past peaks. So I do think the business cycle is a great proxy. You could say the AI CapEx spend should be reflected in Bitcoin price, but let's just wait for all that spend to flow through to the PMIs and then make a decision. U.S. manufacturing PMI is just below 50, services PMI at 50. This is the IWM, which is the Russell 2000 index relative to the PMIs. And you can see it's been taking off, kind of detaching from that correlation to the PMIs. I expect rate cuts to be extremely beneficial for these smaller cap, kind of riskier companies, which do benefit from a lower borrowing cost, as a lot of them are highly leveraged. So maybe the Russell is front running some sort of increase in PMIs, which is a result of all of the infrastructure spend we've been seeing in the economy. I think things are good, but I'm not levered to the gills short term on Bitcoin. IWM Bitcoin correlation, so that's Russell 2000 Bitcoin correlation, about 50%. This is a little overview of the Russell 2000's sensitivity to interest rates. So we can see small caps carry more leverage and larger share of floating rate short maturity debt, so interest expense moves faster with policy rates. See, that's hugely important. One reason why the IWM could be taking off before the business cycle picks up. They rely more on bank lending and refinancing, so tighter financial conditions bite sooner. I think two good long PMI trades are long the Russell with calls or long Bitcoin with calls. I don't know exactly which one's better. I'm a Bitcoin believer, so I'll stay there. I'm going to switch over to Mag 7 AI CapEx spend. And you pretty much got massive CapEx. You can see the 2026 expectations, which is increased from that of 2025 for the Mag 7 companies. No news there, approaching $400 billion in 2025. You can see the AI infrastructure premium on top of total Mag 7 investment. And this is for the first half of 2025 on S&P CapEx spend. You can see how impactful the AI infrastructure spend is. A couple of things to really think about, and there are other people that do better work on this than I, but the inflation risks are real, and especially with rising PMIs, I think inflation will become more of a story as we get farther along into next year. And you can already see the inflation pressures as a result of data center builds being elevated, with that being non-residential building inflation and energy and labor and materials all spiking through 2025 and expected to only increase through 2030. So this will putting high pressure on wages. With the lack of immigration happening over the past year, all of this is putting upward pressure on wages, which is good. I don't know why they call that inflation. True inflation data, you can look at that yourself. And we have the September 2025 CPI data upcoming. Headline CPI is expected at 3.1%, core at 3.1%, monthly at 0.4%. Just to lay the stage for when those come out on October 24th, we can see how they shape up relative to these expectations. You can see the Cleveland Fed nowcast projections as of October 22nd, just shy of the expected inflation. U.S. unemployment rate, unemployment's still not as the Fed continues to say that it is the threat which they're monitoring, and they're willing to sacrifice the long-term trend in inflation to stabilize the labor market, even though the labor market seems relatively healthy in the short term. Those AI impact on the labor market may start rearing its head. Bitcoin gold sitting below the peak in 2022, 2021. I don't think this last cycle is very indicative. I mean, it's a ZERP environment, so it's not hugely, it's a ZERP environment. We saw this crazy blow-off mania. We saw a bear market trough that was largely unnecessary, in my opinion. We saw euphoria at these two peaks, and now we're just looking forward. And so that brings me to the general trend of the Bitcoin network. And you can see the Bitcoin network, the hash rate is growing at a power law to time to power 12, and it continues to do so. We've been hitting new highs in hash rates relatively frequently, and that all plays into the theory of the log or power law price chart for Bitcoin, the best fit trend. And I really like the trend. A lot of people like the floor. I think we have limited data both at the floor and at the peaks. And so for those reasons, I really like the trend. And when we're sitting at the trend, which we are right now, power trend's roughly 118. I think it's 108 by some other people's calculations, and we're sitting, at 108 as we speak. So this is a really good toolkit for understanding where Bitcoin could go if you're a Bitcoin believer, and not overestimating what it'll do in the short term, but then giving it its full credence in the long term. Now you can see here that 2026 is the expected increase in price. I really like using this trend growth rate as an expectation of price over the following year. We can see the power law relationship between hash rate addresses and price, which is the single most important relationship, which sold me on the idea. Then so you saw my performance. I still like Mara a lot. I like CleanSpark. I like those miners, but if they're going to trade like levered beta on the NASDAQ and as just pure play energy plays, I don't want them. I want the IBIT or the Bitcoin embedded call option plus the energy infrastructure play. And if they're not going to behave, then I'll switch out of them. But they're still interesting to me. I'm starting to create kind of a longer term thesis now. I wanted to get through October and potentially November. And if Bitcoin doesn't start running, you can start looking out. In my opinion, you can start looking out 2 years, 1 year, 2 years. Think, okay, how am I going to make the most amount of money based on the expectation of Bitcoin's price relative to the power law moving forward? And so I really love longer dated leaps, getting back to kind of my basics and what works for me, and then using volatility algorithms on a weekly basis to harvest premium and cancel out some of that theta decay while holding those long call options. That's selling calls against those calls based on kind of a little volatility algorithm that I like to use. So continue monitoring our performance on surveyorcapital.com. Let me know if you want to invest. It's been successful so far, and our investors are happy. We have no lockup. Our performance fees are just adjusted down to 1 in 15. We're a small shop. I don't want to be taking aggressive fees. I think 1 in 15 is good. We have a high watermark, so if I lose you money in the first year or in any year, I have to make it back before I start charging fees again. So it really is designed for investors. If I'm not making money, you're not making money. Or if you're not making money, I'm not making any money. So thanks for watching. As always, good to talk, and talk soon.